welcome. I am so excited to do this weekly market insight today with Ted. And the reason I'm excited is not that John isn't here, but that Ted is here. So today we're going to go over just the investment strategy. Welcome, Ted.
Thank you, Aaron. I've been looking forward to this too.
Same. So why don't you just give a little background? How did you get in the investment business?
Well, it started, I guess, when I was in high school. Okay. And I had a very good teacher. And that was in math. And I did pretty well with her direction and her discipline with algebra and high school calculus. And with that aptitude, that led me into getting an engineering degree from the University of Notre Dame. And from there, I just became interested in investments. I thought maybe I would go into, a manufacturing career or something like that. But what appealed to me most was doing analysis. Learned a lot. Learned some of those little threads, that you kind of look back on your life and you say, what did I learn there that has brought me to this point? And there are quite a few of those threads. So I don't think we maybe necessarily want to go through a total biographical sketch. But I think each little segment of my life has added to the whole, which I think is an investment strategy that we're applying today as Gatewood Wealth Solutions.
So you were out in Wichita. Is that where you discovered or came across this strategy?
In a way, yeah. I brought with me off my shelf 3 books that I think were big influential in the development of this strategy. This is a book, and you'll love the title. It's called The Profit Magic of Stock Transaction Timing. You can't resist, this book.
That's right.
But I was working at the time in the investment department of Bank 4 in Wichita.
Okay.
And one of our clients was Beach Aircraft Corporation. We were doing their pension fund. And we were also handling the Beach Foundation investment-wise.
Now, at that time, and it may still be, the aerospace industry was very big in Wichita. Is that correct?
Correct. And the guy that I worked with in the kind of controller's office at Beach, and we talked about investments, and he was interested in investments, and I was responsible for common stock investing at the time. And he said, Ted, you've got to meet this aeronautical engineer that works, in our aerosystems area. He has written a book on investing that has come out of his observations in terms of his aerodynamic work. And he calls it, and it's in here, motion model. And it's very interesting. And he kind of put this together out of what he was observing in terms of testing vibrations in wings and so forth. So as air went over that wing and it began to vibrate, up and down, he thought, now that's an interesting cycle. And I think that cycle repeats itself in nature.
Right, that's what I was going to say. It makes me think of just chaos theory and how order always comes out of chaos. There's a pattern that's always there, and now the pattern will never tell you how to predict what the next movement is.
Correct.
But there's always that order that comes out of there.
Yeah, and you and I have talked about the Fibonacci Ratio, which is derived right out of nature. Right. And there's just a certain cycle that we kind of observe. And we humans, when we walk into a movie theater, chances are and it's empty, chances are we're going to sit 62% from the front of the screen. And it's really kind of interesting to see that pattern, and that's a Fibonacci
And then on
marker.
top of that, once somebody is sat at that 62% mark, somebody else is going to be 62% away, further up.
Down at the 38% level.
Right, that's right.
So it's anyway, that was a big influence, on me in terms of over the years building, an investment strategy.
So how did you initially start to apply? So you're working with the engineer. How did that go? How did you start to do this?
It's hard to say because, I can look back on it now and say, well, I recalled that when I was when I'd become a registered investment advisor, and taken the CFP exam, and I was beginning to work with individual clients on managing money. And I was very interested in technical analysis because there are kind of two threads in a strategy. You know, there's quantitative and there's qualitative. And on the quantitative side is technical analysis, we call it. And that's basically measuring price changes over time. Well, that's kind of the foundation was that what came out of that book, which is cycles. You know, regression to the mean. You know, cycles have, measured by the amplitude, perhaps, and then the duration, and maybe there's some sort of repeat there in terms of stock prices, economic cycles, and so forth. That was a big influence, and I sort of began to put that together with what I had learned, you know, kind of in training earlier on, which was Graham-Dodd, fundamental analysis of stocks, looking at balance sheets and how it related to income statement and so forth to judge whether or not maybe Republic Steel was a good buy now versus AT&T. That was kind of work we did in the trust department. So there were those influences. In fact, I taught an investment course at Newman College in Wichita on the fundamentals. But in that class, to really get the interest, you know, of those students, we started tracking stock prices, you know, from our the hours that we would meet to the next hours, and that's where we really had fun.
So with fundamental analysis, you're looking at the characteristics of the company on a balance sheet or an income statement. What are the earnings per the share price? How much debt are these holding? Where technical analysis is not really paying attention to any of the underlines of the company. It's just looking at that price action. How much change from day to day, and it's really the supply and demand on whatever security is there. Would you say that accurately describes that?
Yeah, excellent. Yeah, just a perfect picture. You know, when in a strategy, if you can bridge the two, you know, fundamentals and technical analysis, then I think you have a investment management strategy. And I think one of the early practitioners of that was Peter Lynch, who managed the Magellan Fund for Fidelity. Marvelous guy, wrote a book, it's on my shelf with this one, you know, and basically he understood fundamentals.
Absolutely.
But he would walk through a supermarket or a department store and he'd see what was moving. And that was really important to him when he made his decisions. If you know, General Mills had some products that was moving faster than Kellogg's, he would buy General Mills, you know, other things being equal. So that was pretty good. You know, I liked that. And so if you could combine Graham-Dodd, Warren Buffett's approach with technical analysis, it seemed to me that might be a good way to manage money for people.
Right. You could say that it's a quality company and it's priced well. It might even be below price.
Yeah.
But if the supply and demand, meaning that people are not interested in the company for whatever reason, you don't want to get into a value trap where you're buying a stock that's unloved. Great that you got a good price, but if it never changes.
Exactly. If it doesn't move,
what good did it do you?
What good did it do you?
Right.
So that's a real part of a good investment strategy.
So we have the technical analysis, at least at the very beginning part of it. What changes have happened? What are the modifications to the strategy that you've noticed over time or have implemented over time?
Well, yeah, you know, incorporating, you know, a better interpretation of the price changes. That's very important, and of course we use charts for it, which you display, you know, weekly. And there's an awful lot of techniques that investors use, usually for trading purposes, which is to draw trend lines, channels, tops, you know, bottoms, trading ranges, and so forth. So those were all sort of important to me, and how I translated that into our strategy was simply going back to the model, the motion model again. Understanding that a phrase that you've used, which is to separate noise from the signal. You may have, you know, good ways of looking at a chart of price changes over time, but what you want to do is use a time periods that are logical, that better reflect really where the trends are in the signal, rather than the noise of short-term volatility. Because after all, we're investing money for the long term, and we understand those ideas, which are price changes. But one of the things that another book off my shelf was this one, which I think you'll like. It's Beyond Greed and Fear. And these are the two elephants in the room always when you're making investment decisions. You've got fear on one hand, you've got greed on the other, and they're just human emotions, very, very real. So you need to formulate a set of rules, out of your technical analysis and how you apply it. And what how that changed was to structure a set of rules on buying and selling based on price motion, and put them over different time frames. And I worked a lot at trying to combine a short-term set of technical indicators with an intermediate set and a long-term set. And if you could put that to music, there might be a reasonable tune between the three approaches. And that's what we're basically looking for. How do they fit? What's the long-term look? Well, is the short-term giving us some sort of signal over here? And is that being confirmed by the intermediate? Well, maybe we should look elsewhere, for an investment idea or something comparable, to invest in.
Now, you initially put this strategy on mutual funds, and can you tell me a little bit about that?
Yeah, I think, I spent a lot of time with stockbrokers, and talking to them about technical analysis and a strategy like that. They just weren't really geared to that. It's like trying to get basketball players to understand how to play football. It's just a little bit different. Just a little bit different approach to what you're doing. But mutual funds, were really expanding over my career, and my gosh, now there's just thousands of them. And so the area that I found, had a real, application was for insurance people, because over time the insurance people were also growing, in terms of attracting assets for management, and the idea of managing was basically to use mutual funds to put them in model portfolios, diversified over asset classes and so forth. And my strategy I began to apply that to asset classes, and then filling those asset classes with mutual funds, and then using my strategy to try to select or compare one mutual fund against another in an asset class. So that kind of took care of the fundamental side, in my opinion, because you could rely on a really solid, good mutual fund company to take care of the fundamental side if they had analysts that you really liked in that. So as we've experienced over the last 10 years, you and I, some of these people that come in representing these mutual fund companies are really smart guys.
They are.
And you can rely on them, and they can tell you, which analysts are really good, they think. And so you begin to kind of get a sense that, hey, some of those fundamentals are really being covered well, because we can choose good mutual funds that way. And then if we aggregate a number of those mutual funds by asset class, then let's begin to sort them. Let's begin to compare one against the other. And one of the things that I was really proud of was being able to put that into a structure of using Excel spreadsheets to do that. It was kind of tedious, but we could manage a lot of individual funds that way. That was the other book, and that made all this possible over the years, and that's Paul Charbonnet, who founded Fast Track, and he specialized in mutual funds. The nice thing about that was he had a software, that you could subscribe to, and you could track every day a change in mutual funds. He's got 6,000 or 7,000 mutual funds that he tracks every day. Well, there are other data sources, but Paul just developed it around mutual funds principally, and then gave you a lot of different charting techniques. So are we digressing a little bit here? I don't want to
No, we're good.
get too granular, with this, but
So would you, one of the things that I love a saying from you on the mutual funds is that typically people would buy mutual funds the same way that they would buy Christmas ornaments. They'd buy them one time, and they'd see them about once every year for a little bit of time, right?
Such a good way to describe that.
But this strategy is different. It's comparing mutual funds to other mutual funds to really find out what's working right now.
Correct.
And if the screen is already there that's been put in place to say these are solid fund managers with great track records and very smart analysts behind them doing the work of good fundamental analysis, but then we're comparing it to say, well, who's got it right now?
Right.
Then we can move money to what is working in the market, and then therefore we're making changes in the mutual fund continually, which is very different from the way that mutual funds historically have been used, or the way that other people use it. It's more of a strategic allocation.
Yeah.
Here's my buckets that I need to fill in.
Yeah.
We've made some adjustments to that strategy. It's not just mutual funds. Can you talk about some of the ways that we apply it in portfolios today?
Well, we've expanded it, to not only comparing mutual funds against each other, but then the main idea is to, compare mutual funds against a benchmark model. Because as John Gatewood always says, we start with a plan. We have a plan for an individual, basically, to meet certain investment goals, So, we want to, make sure that what we're doing is comparing ourselves to a standard so that we can cover our fees and so that we can add value over time to a target for an individual client. And so we're using it, in that way. What that means also is we want other, good fundamental ideas, which is diversification of a portfolio, different asset classes. So we can run our comparisons by mutual fund or ETFs now, which are so
as well as
widely
individual
used,
stocks.
and individual stocks too, which is a wonderful thing you've incorporated, which is to apply technical analysis with a value indicator with the best stocks that are available and that have what you called moats around them.
Well, that comes from
Wonderful
Warren
concept.
Buffett. That concept is Warren Buffett's
Yeah.
concept.
Yeah, it's a great combination of the technical with that. So we run, in our weekly meetings, a report that shows all the stocks that have wide moats and how they're ranking against each other, and what they're showing us in terms of industry classes. So that's a really good application there. And then the other, basically is to say, okay, let's run the indexes against each other. Let's sort them. Which ones are outperforming? Well, today we're seeing a really, really decided move into small caps and mid caps versus large caps. So that gives us a tactical kind of approach to our models so that we maybe take a little bit out of the large cap space, put it in the mid cap space, for example.
So one of the books that you showed was Greed and Fear and Emotions, and you're explaining all the rules and why they're important to follow. Can you walk me through a couple of times that you've been with this strategy where the rules have been very beneficial and helped you deal maybe with humility on these emotions, but also being able to just stay with these rules?
Yeah, there are two really, I think, well, that I recall best, and that was coming out of the 2008 crash. Mm-hmm. And what I had been able to achieve and I was working with a Northwestern Mutual agent who had built a nice book of business, mm-hmm. and had a lot of mutual fund investments. And we were able to, by following the rules, the trading rules, well, we had a 20% decline, in 2008, which
painful.
We didn't like it.
It's painful.
It was painful, but the rest of the market was down here. Right. It was 45% down. So, we tried to explain that to people who are in the fear category. And what was really good about that was we were able to redeploy when the market recovered and to find the asset classes again that work the best. And my gosh, the synergy there, or the exponential return possibilities there, were amazing. so
let's talk about that. So you had the fear that as you're going down. One thing that's always in a person that's trading's mind is, I'm going to get out at the bottom, right? You're hesitant to pull the trigger. You don't get out. These rules will actually push you out at times, and you don't want to do it. But then the important part that you're mentioning is the uptick, because fear doesn't leave you at the bottom, right?
That's right.
It's still there. It's still telling you that it's just too dangerous to get in. So why don't you talk about just how how you see that change in the signal when your gut is saying to be cautious?
Well, and I'd like to digress a little bit here and talk about how we're working with it in the Gatewood Wealth Solutions firm, and that is the team that we use. And you, I think, with your Marine background, are really a good disciplinarian. And you're sort of in between me with the experience and maybe a little more emotional approach to things, to rein things back in and say, remember the rules, remember the rules. And we've got two young guys who are awfully smart, and yes, I'm sure everybody knows them, Tao and Chris, CFAs, in their 20s, for guys. So that combination as a team, I think, is really important. Once again, capital S strategy, yes, an investment strategy that works. A couple of other things, Aaron, which maybe we might mention also, is scale. We have to have a set of rules for buying, selling, swapping, trading, sorting, whatever. But we have to be able to do that at scale. We want to be able to daily, measure up to 6,000 funds. Well, we don't do 6,000, but we do, 500 large cap funds. We do 275 mid cap funds, and we do small cap funds and so forth. So we have scale because of the software that we have. So we get, through Fast Track and other sources, charting and histograms that we can visualize. But what they are, basically they're on log paper, because they measure return. So we can measure a fund that's trading at $200 versus a fund that's trading at $10 and compare them on a return basis and visualize it. Mm-hmm. It's a wonderful thing. You can see a histogram. It's just great.
Rich, you've been in the business for a little while, more than a couple of days, and there's been tremendous change in the amount of data. We can go on Yahoo and look at charting and other components that you would need a supercomputer in the 80s to do some of this stuff.
Gosh, yes.
Can you talk a little bit about the change in the way that people look at markets with this information?
Yeah. Well, yeah, I can go way back when I was
Were you doing point and figure charts?
Sort of, yes. Dorsey Wright's approach to, that point and figure. Absolutely, that was an influence. And by the way, there were more bond houses in Wichita, Kansas than there were stockbroker offices or, New York Stock Exchange. That's serious. I mean, there was more money to be made selling bonds to banks, than stocks to individuals. But, the things you learned there were, tape watching. I do it to this day, I have CNBC working in the background all the time because I'm a tape watcher. I want to see what's going on and where it's going, you know.
Yeah.
So that's been a big change. And in terms of technical analysis, you know, there were some pioneers. Investment Business Daily started publishing, you know, charts, and William O'Neill is a great advocate of technical analysis, and he has, remember, the saw cup and handle
right.
idea, which is, you know, when you come on off a peak, you've got to form this cup over a period of time. And going back to model motion here from James Hurst, you know, if the amplitude of that is great, it's, generally speaking, it takes a long duration, you know, for that to work out. That's a really good concept.
So you're talking about 2008 on how it helped you stay invested, but also make the transitions, but really to get invested. You want to talk about that experience?
Or you can talk about it too. I mean, that's a really good example.
Well, absolutely. We were going into 2020, and the signals were saying that we needed to be in technology, and to be in technology a big way. Now, we were all looking at the data, and we were very well aware of coronavirus and some things. We didn't exactly know how it would play out. Never before have we done shutdowns and lockdowns. And but we knew something was going on in the economy, and that there were major hiccups, where you want to go whenever you want to be defensive is in utilities and consumer staples,
yes,
and some of these value names. But our signals were telling us to be in some of the high flyers, some of these tech stocks like Zoom and Spotify and Amazon, so some of the things that we typically think of as cyclical. And to the point that it was so overwhelming to be signals just pushing us towards that technology that we had to have, I think, which was a very robust discussion of what does diversification mean for a portfolio. And we were able to really have that discussion and move the portfolio to be very technology focused. And this is prior to us having any understanding. I know looking in the rear view mirror, it says, well, that's obvious, we should have been in these things. But we had no experience of a shutdown like this.
Yes.
We didn't understand the work from anywhere, the shop from anywhere, and how much of this would end up online prior to this. But we followed the rules. And you were talking about the 20% down in 2008. I think all of our clients know that negative numbers are negative numbers. Who cares that it's better relative to the benchmark? They're still painful.
Yeah.
And we went through that pain, but we did do a lot better. And typically we get a be defensive, and there's some transition period where you kind of lose the benchmark in that. Well, we didn't experience that. And then on the downturn, when you're supposed to get more bullish, you have that transition period again where you underperform as you go out of these defensive stocks into the more aggressive stocks. Well, the stocks that continued to perform well were the ones that held up during the downturn.
Exactly.
But also they took off during this, and we would have never, prior to this, we would have never said this is how the market was going to respond.
I can tell you, Aaron, that, you know, through my whole experience, I don't think I've ever quite seen anything quite like that. And it really ties to Schefren's Beyond Fear and Greed, because within those two parameters are biases that you build. And you said it well, you know, you're inclined when markets go down to jump to the utilities, you know, and that gets to be a bias, you know, and people have to, you need discipline, because people, you know, they tend to want to hide their losses, you know, or never sell a loss,
right.
You know. Those are biases, you know, that a set of rules that if they're like we've maybe determined so far, that's robust and get you through is a great thing.
We talk about how we have three pillars, which is wealth management, and enabling an integrated technology, but behavioral coaching. And I think you're talking about one that is a behavior in markets, is that you don't want to sell your losers because you think you're realizing a loss.
Yeah.
Why not just hold on? It'll eventually come back.
Yeah.
Which is a bias, and it's actually incorrect. It doesn't matter whether you harvest a loss or not. Is there an opportunity that's going to outperform that security going forward?
Yeah.
Take your loss and go to something that's going to outperform. And I think this strategy definitely puts us there, but it also pushes us, as you were mentioning, into things that there's almost a disgust factor. And this happened last week whenever we were looking at that mid-cap trade, because the signals are telling us to be in value. Now, Ted, I don't need to tell you that value hasn't worked in decades.
I know it. I know it.
And we think technology...
They don't move.
No, we think
Why be there?
technology is the way of the future. It's going to outperform long term. But we are in this rotation of value, and we got to hold our nose and make the change because value's working at that time.
Yeah.
So we can make all the arguments that we want on why technology is the better case, but the market is telling us something different.
Yeah. And it's beginning to spot some of those.
Absolutely.
As I think you mentioned in your review this week, that some of those cyclicals that are down there that have been depressed for so long are beginning to get some traction.
Right.
Man, moving banks, for example, just in the last.
And there's always,
2 or 3 weeks.
I think it was Peter Lynch that talked about how you can have a bad company at a good price, and you can have a good company at a very bad price, right? There is some money to be made whenever you're looking at things that may look like they're significantly out of favor. Airlines have been beaten up. And now our signal, I'm not saying that this is what our signals are telling us, but it's just part of that counterintuitiveness to pay attention to the data, because at some point, they're probably going to bottom, and they're at such good prices that returns are going to be great because they've been beaten down so much.
That's right. And go back to William O'Neill, his saucer and handle requirement, and it's sort of built into our strategy.
Absolutely.
You know, we want certain harmony between those various time periods that we measure to work. And another thing that I think that makes our system proprietary is that we designed a software package and we call it Compare.
Yes.
Because I think it's a really good name. It's our Compare strategy, and that's proprietary. And that makes scale possible. You know, because we can translate all of that into tables that we can look at once a week. We can look at them daily because we run them daily. But at least once a week we meet, look at them, look at our models. This is where we are. This is what the indicators are showing us. And then we talk about some macro issues, which are awfully important.
We've with the new technology, talking about just how things have changed, we actually are able to do it on a anytime basis in the FactSet, which is one of the programs that we've had them help us build the process in. So we actually are minute to minute able to track some of these indicators going forward. So we've talked about how the strategy has came to mind. We talked about how it's done in the past. We've talked about the current performance. What do you think is in store for the strategy going forward?
Well, let's just talk about us. You know, our firm, and maybe there's a little bit of a moat around our firm. You know, John Gatewood and you partners have invested a lot of money in the kind of the infrastructure and the people to operate an investment strategy, once again with a capital S, that has scale. And that scale, I think we can take to a wider client base efficiently and well, and maybe offer that service elsewhere as well. We're
getting near the end, Ted. Why don't you wrap up with and leave our audience with some wisdom?
Well, I'd like to, but I think the wisdom, I think my sister, who's deceased now, but on her 80th birthday, we asked her, Alice, give us some wisdom. And she said, well, don't assume anything and be humble. And I've never forgotten that. And I think that's something to really go by.
Absolutely. Well, thank you. I really appreciate this. It's a lot of fun, and man, I've learned so much from you through this. I just really appreciate being able to kind of sit underneath your feet through this. I remember trades early on where I had this idea. It was a great idea, and I could portray it. I think it was the MLP fund, and you said, Aaron, it's not working. And there's just several things that I've learned from you, as well as the wisdom of just being humble, not assuming, because one thing that I think you could also say is the market's going to humble you. If you go around thinking that you're confident and you know more than the market, it's going to demonstrate that you do not, and it seeks to punish the most amount of people.
Yes.
So anything that everyone else is doing, you want to be cautious about that.
Yes.
But I really just appreciate the time that you spent and bringing the strategy and the wisdom that you've brought to the Gatewood Wealth Solutions. And wow, what a joy it's been to work with you through this time. And I hope all our clients appreciate that what you have done for them to really bring a winning strategy that has proven over time its robustness and its ability to help us manage the chaotic times. And I think as our times become even more chaotic, and with change happening more often, this strategy is going to continue to help us help our clients become and remain financially self-reliant so they can give purpose to their money. So Ted, I just really appreciate everything that you said today and everything that you've helped the firm with while you've been here.
Those are nice words, and I enjoyed it very much.
All right. And don't forget to subscribe here so that you never miss an update. Whether it's the weekly market insight where John and I take a deep dive to give you actionable advice so you can make informed decisions, or to get the skinny on the 3x3, that daily update, and not to downplay how fun and informative interviews like this have been as well. You don't want to miss such an awesome interview with just somebody that's been remarkable for our team. Ted, thank you.
You're welcome.